Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Prospect Capital Corporation quarterly report. Prospect Capital Corporation is a business development company that provides a wide range of financial services to middle market and small-sized private companies. The company's investment portfolio includes various types of debt and equity investments such as secured debt, senior debt, unitranche debt, first lien and second lien, private debt, mezzanine debt, and equity investments. The company focuses on primary origination and secondary loans/portfolios, investing in situations like debt financings for private equity sponsors, acquisitions, dividend recapitalizations, growth financings, bridge loans, cash flow term loans, real estate financings/investments. Prospect Capital Corporation also invests in various industry sectors including energy, industrial, aerospace and defense, chemicals, consumer services, ecological, electronics, financial services, machinery, manufacturing, media, pharmaceuticals, retail, software, specialty minerals, textiles and leather, transportation, oil and gas production, coal production materials, industrials, consumer discretionary, information technology, utilities, pipeline, storage, power generation and distribution, renewable and clean energy, oilfield services, healthcare, food and beverage, education, business services. The company typically invests between $10 million to $500 million per transaction in companies with EBITDA between $5 million and $150 million, sales value between $25 million and $500 million, and enterprise value between $5 million and $1,000 million. Prospect Capital Corporation also co-invests for larger deals and seeks control acquisitions by providing multiple levels of the capital structure. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what might cause a stock price to drop. The stock price of Prospect Capital Corp has dropped significantly over the past year due to various market and economic factors. One possible reason is the decline in interest rates, which has reduced the attractiveness of dividend-paying stocks like Prospect Capital Corp. Additionally, changes in investor sentiment and market trends can also contribute to a decrease in stock value. Another factor that may have contributed to the drop in stock price is the company's financial performance. If Prospect Capital Corp. has reported lower earnings or revenue growth compared to previous years, it could lead to a decline in investor confidence and subsequently a decrease in stock price. Furthermore, external market conditions such as economic downturns, industry-specific challenges, or regulatory changes can also impact a company's stock price. In the case of Prospect Capital Corp., any negative news or developments related to its business operations or financial health could have contributed to the decline in stock value. It is worth noting that every company and market is unique, and there may be specific factors at play that are not immediately apparent. However, by considering these general market and economic trends, we can gain a better understanding of what might have caused the drop in Prospect Capital Corp's stock price over the past year. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified in the extracted summary. On the revenue growth side, several factors contributed to an increase in earnings. Notably, interest income from First Tower Finance Company LLC's loan and dividend income saw significant increases. Additionally, net investment income rose due to higher interest income from investments, while investment gains/losses resulted in a net gain. The issuance of Prospect Capital Internotes with a weighted average stated interest rate of 6.32% also contributed to revenue growth. On the other hand, several factors led to a decline in revenue. Repayments and sales of investments decreased by $348,521, while originations dropped by $235,145. Net debt issuances increased, but this was not enough to offset the decline in investment income. Macroeconomic uncertainty, including volatility and uncertainty in global markets, inflation above target levels, elevated interest rates, tariff announcements, trade negotiations, and geopolitical instability also negatively impacted revenue. In terms of neutral factors, interest income from Valley Electric Company, Inc.'s debt securities increased by 100%, while dividend income from Nixon, Inc. and RGIS Services, LLC's investments also rose. These increases were not significant enough to be considered major drivers of revenue growth or decline. The net income of the company experienced a significant increase between 2024 and 2025. In 2025, the net income was $6,440,000, representing a 217% growth from the previous year. This trend continued with a net income of $6,670,000 in 2025, marking a 223% increase from the preceding year. Furthermore, the company's performance improved during specific periods. The 6 months ended December 31, 2025, saw a net income of $62,567 compared to -$69,295 in 2024, while the 3 months ended December 31, 2025 reported a net income of $49,745, a significant improvement from -$24,733 in 2024. The profit margins also underwent substantial changes. In 2025, the company's profit margin was 49.7%, although it is unclear what this figure is compared to. However, the 6 months ended December 31, 2025, saw a notable increase in profit margins, reaching 65.3% from 38.9% in 2024. Similarly, the 3 months ended December 31, 2025, reported a profit margin of 68.8%, a significant improvement from 39.3% in 2024. The most striking change was observed in the 6 months ended December 31, 2025, where the profit margins increased by 26.4%. The company's financial performance indicates a concerning trend. The operating cash flow for both the 3 and 6 months ended December 31, 2025, is negative, totaling -$3,200 in each period. This suggests that the company is experiencing difficulties in generating sufficient funds from its core operations to meet its financial obligations. Despite interest income being higher in the 6-month period compared to the 3-month period, it is not enough to offset the significant operating losses. The net change in cash flow for both periods is also negative, indicating a decline in overall liquidity. This trend raises concerns about the company's ability to sustain its operations and meet its financial commitments. The company's debt level and interest expenses have undergone significant fluctuations over the past year. While some indicators suggest a decrease in total liabilities and debt level, others show an increase in available borrowing capacity under the revolving credit facility. The interest payable has increased by $684, indicating higher interest costs. However, the interest expense has decreased by $39,914 and $10,266 in different sections of the report. Despite these mixed signals, one clear trend is that the company's debt level has not remained static. The total debt investments have increased from $2,909,659 to $3,221,488, indicating a rise in overall debt obligations. Net debt issuances have also increased by $137,517, suggesting that the company has taken on more debt over the past year. Overall, while some sections of the report suggest a decrease in debt levels and interest expenses, others indicate an increase in borrowing capacity and total debt investments. This mixed picture suggests that the company's financial situation is complex and requires further analysis to fully understand its implications. The company's outlook and strategy are centered around investing in middle-market investments through secured lending and select equity investments. They aim to maximize gains while minimizing losses by carefully considering various factors when determining fair value, including observable market data and multiple valuation models. To manage risks, the company acknowledges financial market risks, such as changes in interest rates and equity price risk, which have introduced significant volatility. They may hedge against these fluctuations using standard hedging instruments, but this may limit their ability to participate in benefits of higher interest rates. The company continues to use leverage and issue senior securities to borrow money, allowing them to incur additional indebtedness and increase investment risk for investors. However, they acknowledge the risks associated with leveraging, including increased volatility in stock price and potential losses on investments. In terms of future plans, the company aims to expand their portfolio by putting in place borrowings and securitizing a portion of their investments to fund cash needs. They may also sell shares below net asset value per share in one or more offerings, subject to stockholder approval. Overall, the company's strategy is focused on balancing investment approach with prudent risk management practices. The company has made several strategic moves to expand and restructure its operations through acquisitions and divestitures. In terms of acquisitions, NPRC has expanded its real estate portfolio by acquiring assets directly or through joint ventures. Additionally, Prospect's incremental investment in RV Industries, Inc. has further strengthened the company's presence in the market. Furthermore, Valley Holdings I acquired 100% of the common stock of Valley Electric Company, Inc., marking another significant acquisition. On the other hand, the company has also engaged in divestitures to optimize its financial position and reduce debt. This includes the repayment of convertible notes due 2025 at maturity on March 3, 2025. The company has also repaid certain notes issued through the Internotes offerings and repurchased or redeemed other notes. These moves demonstrate the company's efforts to manage its finances effectively and adapt to changing market conditions. The company has a history of rewarding its shareholders through various means. One way it has done this is by paying out dividends, as indicated throughout the report. This demonstrates the company's commitment to sharing its profits with its investors. In addition to dividend payments, the company has also engaged in share buybacks. It has utilized several methods to achieve this goal, including converting preferred stock to common stock and redeeming preferred stock at a premium. The company has also repurchased shares under a dedicated program and exchanged preferred stock for new issues while paying out accrued dividends. These actions have helped to return value to shareholders and potentially boost the company's stock price. Concerns about inventory buildup or supply chain disruption are evident in various sectors across multiple pages of the report. On page 56, several industries such as air freight and logistics, automobile components, and food products are highlighted for potential issues. The concern is further amplified on page 117, where a broader range of industries, including telecommunications services, IT services, and specialty retail, are identified as having potential inventory buildup or supply chain disruption. This suggests that the issue is not limited to specific sectors, but is widespread across different industries. While some pages mention general concerns about disruptions due to industry nature, there is no specific information on inventory buildup or supply chain disruption concerns in those cases. However, the repeated emphasis on these issues in multiple pages indicates a significant concern for businesses and stakeholders. That concludes the financial summary for Prospect Capital Corporation. Feel free to comment below, and I will be happy to answer them when possible.